Okay, hello everybody. Welcome to Korean Atlanta Mentorship. In this video, we're going to review the difference between regular velocity banking. I put regular with quotes because it's like the normal one or simple one, and then quote advanced velocity banking. So the two concepts are very, very similar, except to which debts that you pay off. So if you ever read the book Rich Dad Poor Dad, they talk about like assets versus liabilities. So for example, your own personal home is not an asset because it doesn't put money in your pocket, whereas a cash flowing rental property would essentially be an asset because once the rent is paid by the renter, then after all expenses, then it's supposed to put money in your pocket, right? Versus a liability, which is your personal home. So in any situation, your personal home is going to take away money from your pocket, even if, let's say, equity, you have equity or equity is increasing. So after maybe 20 years, the property value is double. It's still considered to be a liability. And if you apply these two concepts, it's very easy to kind of figure out what's regular velocity banking, quote regular, versus the advanced velocity banking. So when we talk about velocity banking videos, a lot of it has to do with debt pay, like your debt payoff. You pay off in your own personal situation. So if you have student loans, car loans, credit cards, your home loan, it's tied to you. But what happens when you pay off that liability, right? You just have one less debt. So it's more about a wealth creation mindset, right? So think about that. And also, if you've never done the math or not really too familiar with just the velocity banking concepts in general, go ahead and watch the Velocity Banking 101, 102, and Advanced Velocity Banking 101 videos, and you'll see how to do the math and how to apply the strategy in your own personal situation if it's possible. Okay, so if we go down here, it's really, really simple. It's basically more about what you pay off. Is it an asset or a liability? So with regular velocity banking, it's just you're just paying off debts that are assets. A student loan is not an asset. An auto loan is not an asset. A home loan is not for an asset, right? These are all just liabilities. No matter what you do, they're all going to take away money from your pocket. But if it's some sort of a business, right? Something related to a business, whether it's rental property, maybe you have like Uber or Toro, and then once you've done the math, you have a debt associated with the asset, and then once it's paid off, all it is a debt. Once you pay it off, then it becomes about wealth creation, and that let's say we'll take a rental house, we pay it off, then what happens? Then your cash flow explodes, right? So I'll just kind of do a quick example here. And again, if you want to see the math done or just kind of more detailed, go ahead and click the other velocity banking videos in the links below in the details section and then come back here. But this is more just an exploration of the mindset. So let's say you have one rental property, right? And what happens with that rental property if you have debt? So if you have debt, and let's say it's maybe like a, I don't know, $200,000 house, $250,000 house. Whoopsie. $250,000 house. And if you have debt, what's the likelihood that you'll have good cash flow? Probably zero. So maybe the cash flow will be $0 to $300 a month, right? And that's not that much cash flow. So if you have maybe a 2,000 or no 1,400 a month, so let me just restate that. If you have a renter who's paying about $2,000 and your debt, your liability is about 1,000 to 1,400 after all expenses paid, you're not going to have that much left over with debt. And so if you pay off that debt, you go from no debt, that will increase to maybe 1,700 to 2,000 of cash flow a month, right? And so a rental property that normally would take about 30 years to pay off because that's what a 30-year mortgage does. you pay it off, but here's the thing, you don't just use the rental property money, right? Because if you use the rental property money, it's only going to take, I mean, I shouldn't say only, it's going to take about 12 years, 12 to 15 years to pay it off quickly. So now that's much quicker than 30 years. But what you got to do is not only use the rental properties income, but also all your other incomes so that instead of 12 years, 12 to 15 years to pay it off, which is still really fast, you're going to pay it off in 3 to 5, right? So that's essentially what you want to do. So think about this. Once rental property is paid off, you've increased that cash flow to an insane amount. So let's say 2,000 divided by 300, that's like almost 6 times more cash flow when you have no debt. You pay it off in 3 to 5 years, then it becomes a snowball effect, and then you rinse and repeat, right? So now you have rental property number two of the same type of house. So if you have debt, again, $0 to $300 cash flow a month, but you have no debt, then that cash flow explodes. It's like an explosion of cash flow. And not only that, so again, if you use the rental property income only, then it's still going to take a long time. 12 to 15 years is kind of a long time. 30 years is a long time. But let's decrease it from 2 to 4, right? And so now each rental property that's paid off is essentially going to have this snowball effect. Now, I don't know your personal situation, right? But this is house number 3. And then again, might be 1 to 3 years. And then every house that you buy is going to accelerate the payoff of every subsequent house that you have, right? So that's the difference between the regular velocity banking, which is you just pay off your liabilities quickly, like your loans and your mortgage, your own personal mortgage, versus the debt of an income producing asset. You take away the debt of an income producing asset and your cash flow will explode. And then subsequent assets that you acquire will be paid off quicker and quicker. So again, it's like a snowball effect that's rolling down a hill. It's becoming bigger and bigger and bigger. And that's why we call it like a wealth creation mindset, right? So that's the only difference. You don't have to know the exact numbers of understanding velocity banking or advanced velocity banking. In fact, the only difference between the regular velocity banking and the advanced velocity banking is what are you applying it to? Are you applying it to an income producing asset or maybe one of your personal liabilities? Now, it doesn't mean that it's not worth teaching the regular velocity banking because the average person lives paycheck to paycheck. So they need relief in their own personal lives in order to step it up to the next level. So all advanced velocity banking is just stepping up to the next level, right? So here's the thing, you ever seen like in the airplanes where they say, if there's some sort of an event, like something's happening on the airplane, put the mask on yourself first before you put it on the child. Same thing, before you pay off, go ahead and acquire income producing assets, you probably have to take care of your own personal self before you take care of your business. So you have to pay off your own debts first. It's probably best to do that, or at least a majority of them, so you have like a lot of cash flow, versus trying to acquire assets when your own personal ducks isn't in order. So I hope that makes sense. And the only thing that I would say that it wouldn't apply is maybe to your own personal home, because that might be a big debt, but the amount of cash flow that you get if you pay that off quickly wouldn't be as great compared to paying off your other loans like car, student loan, auto loan. And if you pay those off quickly, then you could acquire a lot more cash flow in your own personal life to be able to pay off income producing assets. All right. So this is Korean Atlanta Mentorship. Hope this was helpful to understand the two different velocity banking mindsets. Both are which are valid, but when you're starting out, I definitely recommend learning the regular or the standard velocity banking. And then once you've paid off enough debts to have enough cash flow in your own personal life, then as you're acquiring assets, then you go to the next step of wealth creation and paying off those debts quickly so that you can increase your cash flow to another level. All right. If you're interested in joining our group, go ahead and click the link down below to the Google form in the description, or you can email us by finding out our email address in the About page of our YouTube channel. Have a great day, everybody, and we will speak next time.